so you can reference it later, or if you have joined late, you will be able to go back and reference it. So today's webinar is going to be about ACA, but we're going to focus on the practical stuff. That's why we titled it. You probably have all heard bits and pieces about the ACA. Maybe you focus on the individual penalties. Maybe you focus on the under 50, whatever the case may be. So we're going to focus on what people actually have to do to stay compliant with the ACA today in a practical manner. Before we begin, this webinar is going to focus over 50 full-time employees, and we'll talk about that in a little bit. But just to clarify, because I know I got a lot of questions prior, there are no requirements for under 50 employees for the employer level, so that should pretty much sum that up. So let's go ahead and get going. All right, a little bit about myself and payroll services. Again, my name is Jonathan. That's a picture of me sitting there on the beach. I just took that this weekend on the 4th of July, holding my whiskey there. I am the managing partner of payroll services. I actually started in the public accounting industry, did it for many, many years, and I decided that's not necessarily what I wanted to do. So I guess you could call it I was stupid, and I got into payroll instead. So I went from one thing out into the other, and I actually enjoy the payroll side of things. We focus on HR, employee benefits, and much, much more than just filling out 941s. We are also fully licensed for all insurance and benefits, so we do everything from group health to life to disability to you name it. So it really has allowed us to be exposed to a lot of different things in the industry and to see really how the ACA is affecting clients. We've been in business for over 10 years now, and we service over 5,000 employees nationwide. We have clients ranging from 1 to all the way up to about 500 employees, and we provide everything from payroll, HR, and employee benefits. And one of the neat things that I kind of pride myself on is we've really been up to date on the ACA. We are ACA experts in this area. We've been doing CPEs for insurance agents, and we've been talking about the ACA since it started coming out. So today's agenda, we're going to talk about, again, the practical stuff that you need to know, that clients are going to come in and ask you questions that you need to be able to give them answers to. We're going to get into the actual process of doing this and what you need to tell your clients. And so this is the agenda. We're going to talk about ALE calculations, the ongoing employer penalties, the exemptions for this year, what affordability means, employee tracking and classification, what we call the MAS, as well as 1095C reporting, which I'm sure everybody's trying to figure out how they're going to do this for their clients. So let's first talk about the elephant in the room. Everybody that I talk to is really focused on the 1095C, so I want to address that first. Preparing 1095Cs is nothing like your 1099, where your client is going to give you some information, you know, so-and-so corporation, $5,000, here's the EIN. That's not the way it's going to work. There's so much more in preparing the 1095s. The way I relate to it is that thinking that you can prepare just a 1095C is like trying to walk your dog but forgetting your dog. It's not that simple. There's a lot more into it, and that's why we need to discuss all these things that go on with the ACA. All right, so an ALE, this is our first thing. What's an ALE, okay? It's not a beer. It's what we call an ALE is an applicable large employer, okay? And essentially what this means is that you have employees that total over 50 full-time equivalents, or what we call an FTE. Now, an FTE is very simple. 1,560 hours worked in a year equals 1 FTE. It averages out to about 130 hours a month or 30 hours per week. Now, where this gets confusing is if you have clients with lots of part-time staff. Maybe they do an ice cream shop, or maybe they are a cleaner or a lawn care service or something like that. Well, if you have 2 employees working 15 hours a week, well, that would equate to 1 FTE. So that's where all of this complication starts occurring. Many clients, believe it or not, still do not keep track of accurate timekeeping records, and we'll talk about why that's really important later on. There is an asterisk there at the bottom talking about seasonal employers. For example, we have a client that is a lifeguarding company that is very, very seasonal heavy. So starting Memorial Day through Labor Day, they spike. They may have 300-400 employees, and then afterwards they may drop to 5. So the exception for your seasonal employers is if they are an ALE for 120 days or less, and it's caused by seasonal employees. So they would be excluded from this calculation. However, if they have 50 or more FTEs for longer than that 120-day period of time, then they would be considered an ALE. So it's really important when we talk about ALEs to understand what you're looking for and to classify your clients as to, okay, these are the ones that we need to focus on and we need to sit down and have a plan for. The next thing about the ALE that I'm sure you've all heard of is about the controlled group, okay? A controlled group is essentially where you have a client that owns multiple businesses. And I know everybody here on this webinar today has clients that has multiple businesses. I have multiple businesses. So what we need to do is how do we figure this out? In this little diagram right here, it says, you know, the Great Company has 3 full-time equivalents, Stinky Inc. has 15, Awesome Company has 68, and Fantastic Inc. has 20. So how does all of this relate into the grand scheme of the ALE? Well, as far for controlled groups, there's essentially 3 types of controlled groups, and we're going to focus on one of them for a while here, because that's the one you're going to run into the most. But essentially, you have what's called a parent subsidy group, you have a brother-sister group, and then you have a combined group. A parent subsidy group is very simple. You have a management company that owns multiple different companies. You'll see this a lot with maybe like a daycare center where they have multiple locations and they own property. They'll set up a management company, and then the management company will own all these different subsidiaries underneath of it. Well, that's part of the controlled group. The second type of group, which is the most common one, is what we call brother-sister groups. This is where a business owner and their partner have multiple businesses that they own, maybe jointly, individually, or with different individuals. And that's really where you're going to have to do some calculations to figure out what's going on here. A combined group is very simple. It's a combination of both of them. All right, so the parent subsidy group, like I said, is very simple. You have a management company that owns different companies here, and the threshold is 80%. So if the management company owns 80, 90, and 100, or whatever the case may be, well, then all those 3 companies are going to be included in the FTE calculation. So if company 1 had 10, company 2 had 20, and company 3 had 30. Well, we would combine those all together, and now we know that the management company is considered an ALE. So these are things to consider when you're consulting with your clients and when you're even looking at your customer base right now to see who you need to bring in and have these conversations with. The next one is the brother-sister group. And this one, it seems a little bit confusing, but we're going to lay it out so you're going to own this material when we're done. So it's very simple. The common ownership rule is what we call identical ownership. Essentially, if you look at the example here, we have ABC Company, and then we have XYZ Inc. What you would want to do is list out every shareholder or owner and the amount of interest that they own in that company. And what you're going to do is take the identical ownership of those 2 companies to see if it equates to 80% or more. And if you see here, we're looking at shareholder A. Even though shareholder A owns 50% in XYZ and only 33, we use the lower number. That would be the identical ownership. Likewise, shareholder B and C, the identical ownership would be 25%. So it's very simple. When you have clients with this, write out all the businesses that they own, list the owners, and then go down and just simply write the percentage that they own. Use the lower number that's in common with all of them, and that's how you'll know if that company contributes to the ALE calculations. This one, again, it's the most common one, and you're going to want to make sure that you understand how to do this. So I'll just say it one more time with it. We're going to take all the companies, list them out. we take all the owners, we write down the percentage shift that they own in each company, and then we take the lesser of the common denominator of all of them. We write those down, and that would dictate the identical ownership here. All right, so now we're going to talk about the penalties. The penalties this year, there are some exemptions which we'll talk about, but we're going to talk about ongoing penalties and what you need to know about. All right, so the first one is that the company doesn't offer insurance. Well, and the employee goes to the marketplace, and this would be a .gov site. So just because you don't offer insurance, if they go to carefirst.com directly, well, the employee's not eligible for a subsidy, so that wouldn't count. They have to go to the marketplace, which is the maryland.gov website or the fed.gov or whatever the case is. If they go to the market and they get a subsidy, the penalty is $2,000 per full-time employee minus the first 30. Okay? So again, the penalty only kicks in if the employee gets a subsidy. Well, how do they get the subsidy if we don't notify them or whatever? Well, back last year, I think it was, or the year before, employers were supposed to send out a notice to the employees letting them know about this. So again, if your client didn't do that or your broker didn't do that, then you could have some other fines and penalties that you could be faced with. But based on this example again, is if we have 50 full-time employees and we only have one person that got a subsidy, only one, then it would be, we would subtract the 30, which would leave us with 20. So we would take 20 employees times the $2,000 penalty, and it would be a $40,000 penalty for the employer. These penalties add up very, very quickly. We also call this a pay or play strategy. Sometimes the employers will take the penalty because it'll be cheaper than offering insurance, and we'll talk about that a little bit further. The next type of penalty is what we call whether it's unaffordable or inadequate. Inadequate coverage is really a non-existent thing anymore. Most of the plans, about 99.9% of the plans that brokers put in place are considered adequate because the carriers, they only offer plans that are adequate coverage in accordance with the ACA or Obamacare. So what you end up getting is more of this offer unaffordable coverage. And what happens is this penalty is much more steeper. It's the lesser of $3,000 per subsidized full-time employee, or the $2,000 per full-time minus the first 30. That's a lot. That's really complicated when you read it. So let's put it into an example. So let's say we have 2 employees that go and they get a subsidy. Well, based off of this penalty, we would take the 2 employees times $3,000. It would be $6,000. Okay, that would be the penalty. But let's say if 14 people got this subsidy, it would be 14 times 3 would be $42,000 in penalties. So the cheaper penalty would be the $2,000 minus the 30, as you see in this example. So the way that we calculate this penalty, again, and I know it sounds really confusing when we say it, because it is, but when you write it out, you're simply taking, okay, how many guys got a subsidy times $3,000 bucks? What is that number? Is that number more than the penalty if we didn't offer insurance? If the answer is yes, then we just go back to the first topic where we say, hey, the first 50 minus 30 times 2,000. So again, these penalties, these are more or less for you to be talking to your clients about. Your brokers, the brokers should have been having conversations about this with their clients. However, most of them have not. So we'll get into what do you do when the client doesn't know what the heck's going on in their business with this. Now in 2015, we do have a couple exemptions. Now I want to stress this because there is a huge misconception going on even amongst the accountants and the CPAs, and I'm getting calls all the time by clients that are telling me, well, hey, I don't have to do 1095Cs this year because there's an exemption. That's baloney. Every single client that's over the 50 FTE mark must file the reporting of the 1095Cs. The exemptions only apply to the penalty, or what we call the employer shared responsibility, okay? So for 2015, if you have clients with less than 100 full-time employees, instead of the 30, they're going to go ahead and give you an exemption up to 80. So instead of doing 100 minus 30, it's going to be 100 minus 80. All right, you're still required to do all of the reporting, and you need to make sure that you're ready to rock for 2016, because this is just a one-time exemption unless something changes. And again, like I said, with the ALE with 100 or more, it's reduced by 80 rather than the 30. So the penalty will still apply. They're just increasing it. So if you have anybody that's in the 50, 60, 70 range, this year there's no penalties. So that's kind of your out. So for conversation purposes, if they come into your office and you know they have less than 80 employees, simply say, listen, you are in the realm of penalties, but don't worry. This year you have an exemption, but we need to make sure you're squared away for 2016. Because after you're done this webinar, you're going to know a lot more than probably what you have in the past, but you're not going to know enough to be able to completely educate the client. So what we want to do is give you the tools to be able to kind of kick the can down the road to get them to somebody that can give them all the answers and assist you with creating this. All right, so the next thing is what is affordability, all right? Affordability is a mathematical term for every single employee. When I say mathematical, the health insurance premium needs to be 9.5% of their gross income. So, for example, if I make $100,000 and you make $200,000, your threshold is going to be much higher than mine. So affordability is different for every single employee. And guess what? The client needs to know this. They need to know, all right, I have 50 employees, and here's what's affordable for all of them based off of the plan I'm offering. Now, the IRS has came out and given us 3 different affordability safe harbors. All right, one is what we call the Form W-2. The second is the rate of pay, and then the third is the federal poverty line. So let's talk about which one we use and why we don't use the other ones. First off, everybody here knows what a W-2 is. W-2s are issued at the end of the year. So let's think about this for a second. If I use the Form W-2 safe harbor, that means I'm calculating it back in the following January probably, or December or whatever. Well, that doesn't do me any good because that's, a day late, a dollar short. So that one doesn't work as well. The federal poverty line safe harbor is another viable method, but it's one of those that's kind of confusing. Not too many people know what the FPL is. So what we like to focus on is what we call the rate of pay safe harbor. It's very simple. Let's say today an employee becomes eligible for insurance. We take his rate of pay, we forecast it out based off of what we're paying today, and then we simply multiply by 9.5%. And that's how we would get the affordability for the employee. That is what we recommend to all of our clients, is to make sure that you're just using the rate of pay. And again, based on my example here at the bottom, if we have a $40,000 salary today times 9.5%, the premium for the employee-only portion may not exceed $3,800. Now, as far as salaries go, it's really simple. So how do we deal with it with hourly? Well, that's very easy too. So what we're going to do is, if you remember, a FTE equals 130 hours a month or more. So we take that employee's hourly rate, we multiply it by 130 hours a month, we multiply that by 12 months, we multiply it again by 9.5%, and that will give us the annual premium that we may not exceed for the employee portion only. And I want to clarify that. So if this guy that's making 10 bucks an hour is married and has a kid, well, he's going to have family coverage. That's okay. He simply has to be affordable for the employee-only portion. So if family coverage is $1,000, but employee-only is $300, we just have to make sure he meets that $300 threshold, okay? So this is all great. You go, all right, fantastic. Now I know what affordability is. But, okay, what happens if it's not affordable? What do I do? And this is a huge problem for a lot of clients because let's see, okay, what can we do here? Well, I can increase the wages, right? Absolutely, that's a viable solution. What if I go ahead and increase the contributions? This is one that's been going out and a lot of people have been talking about. And here's the one thing, if we increase contributions, what do we talk about by increasing contributions? Well, if my company is going to go ahead and pay $300 a month for employee coverage, and this guy needs it to be $375, can I do that? Did I discriminate? Think about that for a second. And this is a big one that I want to kind of pause here. So that way when you're talking to clients and you're listening to people, you can kind of say, hey, wait a second, this may not smell right. You can absolutely contribute different rates to different employees. However, it must be consistent throughout the entire company setup. So let's make an example. All right. If I have executive staff and I'm going to pay $1,000, that's fine. But every person in the executive staff must have $1,000. If I have admin staff, I'm saying, okay, $300 for admin. I would have to go ahead and pay everybody for $300 for the admin. The point is once you set up these classes, whether it's by tenure, whether it's by occupation or whatever, you have to stick to those. So if you go ahead and say, wow, well, I got this entry-level admin guy that's making $10 and now he needs insurance, you can't just arbitrarily jack his contribution because then you are discriminating. So these are some of the things that you have to think about when we're taking a look at it. So again, the next thing is it worthwhile to take the penalty? We call this the pay or play, because if I have to go ahead and increase this guy's salary or increase his contributions all throughout the company, it may make sense to take the $2,000 penalty. $2,000 is a lot cheaper than paying $300 a month. So these are some of the things that we're talking about with it. What do we need to do when we're talking about affordability? All right. The next thing which will prompt affordability is we have to talk about employee classification, okay? There's 3 types of classifications for employees: eligible, ineligible, and variable, okay? Eligible is very simple. You hire somebody that's expected to be full-time. He's eligible, okay? He's going to get his insurance. Ineligible is something that we don't say that you should classify any employee at until we get through a measurement period, and we'll talk about what that is in a minute. The third class is what we call variable. A variable employee is an hourly worker that you don't know how many hours he's truly going to work, okay? Now, clients are going to say this, oh, come on, Steve, he's only going to work 15 hours a week and consistent. Baloney, okay? The guy's going to work 15 hours, and then he's going to get busy, and then he's going to start working 20, and then 25, or maybe he becomes a superstar, and he goes, all right, now he's going to be working 40 hours a week. He's a variable employee. So you either have eligible or variable. Never let clients classify somebody as ineligible from the start. That's where penalties start occurring. And again, you know, these are employees. The variable employees are ones that are hourly and that you don't know how many hours you're truly going to work, okay? So 3 classifications: eligible, ineligible, and variable. So employee tracking. How do we know which employees are eligible if they start out as variable? Well, through timekeeping. And so we're going to take a quick moment here and kind of reverse back to some of your clients that you may have had for many years. Maybe they're mom and pop shops that have been growing that have liked the old school method. All right. If you have clients that are over 50 full-time employees, you must make sure they have some type of electronic timekeeping system in place. Okay. Punch cards won't work because you have to run analysis on this stuff. Are you really going to be sitting in your office tallying up a bunch of those old peach-looking color slips where you're tallying every employee's hours for the week and then trying to putting it in a spreadsheet? No way. It's a waste of time. So you're going to want to make sure that they have timekeeping. The other thing that I'll drop a little bit of a bomb here is I'm not sure many of you have heard about this, but now President Obama is proposing to the Department of Labor to change the overtime rules for salaried staff. And the change is this: anybody that makes less than $50,000 a year salary will be eligible for overtime. So that person that's making $45,000 in your office, well, if they work 41 hours, you have to now pay them 1 hour of overtime, okay? The proposed change is supposed to be implemented in 2016. So you need to start having conversations with all your clients about timekeeping, regardless of whether they are an ALE or if they're just, 10 employees or whatnot. Okay, so once we have a timekeeping system in place, we can start tracking our variable employees' hours and to figure out whether or not they're going to become eligible or ineligible. And the way that we do that is through what we call the MAS process. Okay, the MAS process stands for the 3 periods of time that the ACA dictates to figure out whether an employee is eligible for insurance. We have the measurement period, the administrative period, and the stability period. We're going to focus quite some time on the measurement period because it is the most complicated one out of all of them. But in a simplistic manner, a measurement period is a 3 to 12 month consecutive window of time, which is going to measure the hours of these variable employees to see whether they're eligible or not. Okay, so just for example, January through December, we're going to take a look at a snapshot in time, and we're going to figure out if they're considered eligible or ineligible. Now, here's the thing. The IRS rules allow you to go from a 3 to 12 month window. There's no reason for anybody to do anything less than a 12-month consecutive window. If you have anything less than that, your staff that is going to be administrating this, or the client or whoever, does not need to be doing measurement periods every 3 months. You should be doing it every 12 months. The second thing is the administrative period. This is one of the easiest things to get. It's simply the time that it takes to get the employee enrolled. From the time you find out they're eligible, you have no longer than 90 days to get them in insurance. This is a big thing. Most of the brokers were pretty good about updating this. A lot of people used to have, okay, the employee will be eligible on the first day following 3 months from his date of hire. The problem with that is that puts you over the 90-day threshold. So what we recommend to everybody is no more than 60 days following the date of hire on the first of the month. No more than that for your insurance. So if you hired him on February 15th, March, April 15th would be 2 months. He would be eligible on May 1st. That puts you under the 90-day threshold. Very simple with that one. Just you have to get him enrolled in less than 90 days. The stability period is a 12-month period of time that correlates to the benefit plan usually. It's just the period of time that the employee's actually got coverage. So if he gets on the plan May 1st, well, his stability plan is May 1st to May 1st. That's the way that works. Again, administrative period and the stability period are very simple. You shouldn't have a hard time explaining those things. But let's talk about the measurement period because this one is a mess. All right. So first and foremost, I hate to tell you this, but every client that is now freaking out about the ACA is way late, all right? Every measurement period was supposed to be initially started back in October 2014 to comply with 2015 rules. So if your client didn't have a measurement period yet, oops, now we're going to have to go back and do a backward analysis to figure out what's going on. A lot of brokers, I hate to tell you this, you're going to call your clients up, and I do it all the time because I'm in sales. Hey, Mr. Client, I'm calling to talk about ACA. Do you have a policy in effect? Do you have a solution? Oh, yeah, I got it, John. Don't worry about it. Oh, really? Okay. So you know that you have your measurement period, your stability period, your administration period, and blah, 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 blah. They have no clue about this stuff. The brokers are going ahead and saying, oh, yeah, we got it. They don't got it. This is something that you need to make sure you reach out to every single client that is eligible here and make sure that they have a measurement period established and that all these things we're talking about are in place. Again, initial periods were supposed to be established no later than October of last year, and that was to figure out what the stability period would be for 2015. Again, back to our example, if we end in October, you have 3 months to get them enrolled, which would put them from a January 1 start date. Okay? When we develop measurement periods should be designed to correlate with benefits. Okay? So, for example, if your measurement went to October, you're going to take those 3 months I just talked about of administration period to get them enrolled. Then your plan should start in January. So if you see, that's kind of the way that we should be doing with this. So in my example down here, we have an enrollment, we have an initial measurement period that ended October 2014 or October 31st, 2014. We have an admin period of 90 days, and then our stability period goes for 1 year, okay? What we're doing here is we're making kind of a leapfrog so that way we can go ahead and actually set this up so we have enough time to do our analysis. Then in year 2, you'll see it again. The measurement periods. Doesn't know what the measurement period is, chances are we're going to have to do this exact example here to figure it out, because this is the most lenient way, or the lenient way of dealing with this. Conservatively, we would have liked to see a measurement period started maybe from 2000, January or whatever. However, the plan was coordinated. We would want it coordinating with the enrollment period. All right, so you're saying, okay, John, this is great, but how does this wrap into new hires? Because this is a company measurement period. Well, let's confuse you a little bit here. Every time your clients hire a new employee, that new employee has their own initial measurement period. Okay? So we got to look at the example here to kind of clear this up, because again, this is the most confusing part of the ACA. If I hired somebody on April 1st, 2014, remember, my measurement period is 12 months, 12 consecutive months. So that means that I'm going to run that measurement period from April 1st all the way through March 31st or April 1st, 2015, whatever. There's your 12 months, okay? Then the employee will either be eligible or ineligible based off of the 130-hour rule. Okay. Remember, our FTE is 130 hours a month or more. So you're gauging that employee. Did he work on average 30 hours or more each week? If the answer is yes, after 12 months of measurement, then he goes into administration period, which means we have to get him enrolled. Now, once he's enrolled, that employee has a 12-month stability period. Okay. Now, if you remember in our previous slide here, that the initial stability period for the company or the benefit policy runs from January to December. Well, this guy is eligible from May 1 all the way through April 30th. So again, if you see here, we are now off schedule here. So we have this sliding scale. And every time you add a new employee, they're going to have their own initial measurement period, okay? So if we hire somebody down in June, well, now we're measuring from June to June, and then he would be eligible for insurance or should be enrolled by September. So this is kind of a leapfrog effect, and you need a system in place to be able to track all these individual new hires, okay? Because here's the other thing. Just because they're not eligible doesn't mean you can say, well, he was ineligible, I don't care. You have to track it to be able to document this, okay? If you come back and you get an audit and you say, oh, yeah, John was ineligible. Okay, prove it. Oh, all right. Well, what was the measurement period you used? Well, I don't have that. Well, that's a problem. So you need to have a system in place that will take those timekeeping information that we just talked about and format it into a way that will establish all these initial measurement periods for new hires. And again, if we look at year 2 here, you'll see that the standard measurement period is our company measurement period. We have our standard measurement period goes from October to October. So again, based off of that new hire, the new hire we are going to measure from April to April. We're going to say yes or no. If the answer is yes, he's going to enter into his stability period. However, for ongoing years, we will then use the company's measurement period. So even though he's now eligible for 1 year, if we measure from October to October and we find out now he's ineligible, once that employee exits his initial stability period, he's now ineligible for insurance and you can kick him off. Okay? I know this is really confusing. Try to take a look at the graphics with it, but again, guys, this type of stuff, this is what makes the ACA so daunting, because of all this leapfrog effect and how you have to kind of move the sliding scales with it. There is really no easy way to explain this other than by doing a graphic or by actually taking an employee and doing it. So again, what I would tell a client, if it was me, I would say, hey, you have to have a measurement period. And then when you hire new employees, that new employee has their own individual measurement period. And then we keep stacking on top to figure out whether they're eligible or ineligible. Again, what we're trying to do is just equip you to be able to talk enough to be able to say, okay, the client's going to leave your office saying, yes, I learned something and now I need to do something about it. You don't have to be the expert in it unless you want to. All right, so the next slide here is the administration period. We already talked about that. Again, 90 days, very simple. The stability period, again, is your 12-month period of time where they're going to be enrolled into the benefits. All right, so we got somebody that's eligible. We put them through the measurement period. Now what do we need to do? All right, because again, it's not just about filling out 1095s, guys. We have to make sure that we avert all these penalties. So the first step that we need to do with this is we need to notify the client. Hey, Mr. Client, Joe Smith is now eligible for insurance. We need to also notify the employee. Hey, you're eligible for insurance, or you are ineligible for insurance. We still have to notify that person. The third thing is we need to notify the broker. Okay, so now we got a lot of communication going on here. We figured out what's going on for this individual employee. Now we got to talk to the client, the employee, and the broker. And you need to do that for every single new hire that is onboarded here. All right, so before we get into a recap here, we're going to just take a brief moment to talk about ERISA. Okay, I'm sure every single one of you here that's listening has been faced with somebody that has tried to sell you ERISA fear tactics, okay? I hate to break it to you, they're absolutely correct, okay? ERISA is something that must be considered in the ACA. It's really weird because you would think that how would my medical plan and ERISA really take effect with this? But because of the laws are all overlapping and everything, we have to take care of this. I'm not going to sell you ERISA fear. I'm just simply going to tell you a couple items that you must have in place, okay? Wrap docs. I'm not going to get into what these are. You need to make sure that your SPDs are correct with ERISA language. An SPD essentially is the benefit summary that you get from like Care First or Aetna or whatever. Those SPDs are not correct, so you do need to make sure that they are reviewed by somebody that knows what they're doing and get the proper language in. There's a ton of documentation, okay, that needs to be sent out. We have PPAC notification. We have ineligible, eligible. We have COBRA, HIPAA notices, the whole 9 yards. I mean, there's tons of stuff. So you could get really deep into ERISA, and you could say, okay, all right, well, if we really were looking at it, this client has X $100,000 of risk. That's something that you're going to have to assess. As a broker, we go through and we show the client, hey, these are the things that you need to take care of. These are what we recommend, and then we let the client go from there. The way I relate ERISA is I could win the lottery today, but it's probably not a good chance that I will. That's kind of the way that the ERISA works. If you talk to an ERISA sales guy, they're going to quote all sorts of audit numbers and things like that. They are absolutely right. I don't want to discount it, but it's something that you are going to have to wage. You're going to have to weigh the risk versus the cost of doing this stuff. All right, so let's do a quick recap here. So we need to get an FTE calculation first to figure out if the employer is even required to do all this stuff. We then need to do affordability calculations and ongoing affordability calculations for every single employee. We also need to set up the appropriate measurement, administration, and stability periods. We need to classify the new hire measurement periods. We need to ensure proper enrollment. We need to ensure that we're tracking our variable employees throughout the year. And we need to make sure we have a timekeeping system implemented so that we can do all these analyses in some type of streamlined way, if that's what you want to call it. All right, so let's talk about the 1095C now, right? This is why all you guys joined up. How do I do my 1095Cs? All right, now you can fill out the 1095C, right? Nope, sorry, just kidding, guys. Again, this stuff is a mess, all right? The 1095-C, here's some of the things that you have to get for all of it. Remember, I started off by saying this is nothing like a 1099. Well, if you have any type of client that's doing self-insured, you're going to have to get dependent names, social security numbers, and date of birth. All the other stuff you say, okay, well, let's see, the date the coverage was elected, declined, waived. Well, you're the accountant. How are you getting that information? Oh, we reinstated this guy because we fired him and then we brought him back on. Here's one that I bet you're probably not thinking about. What about people that you fired that actually enrolled into COBRA? Yeah, those are guys that need to have all the information reported as well. There's a ton of stuff with this. And so the question comes with this is like, all right, John, you're telling me all these problems. Is there a solution? Is it really possible for you guys to do this? All right. Well, here's the question that I have for you. Okay, can you do it? Sure. Are you going to be the broker? How about, are you doing payroll yourself? That's a topic for another day. Are you going to implement your own timekeeping solution? Okay, I told you, you guys have to have a timekeeping solution. Timesheets don't work. Are you going to try to implement some type of new employee onboarding process? Because now you have all these information you got to capture. How are you going to do this now, right? And here's the biggest problem, and this was like the oh crap moment. I can't find a single company that's offering any type of fillable 1095-Cs. Like, we call up CFS. They're not doing the 1095s. And we're like, okay, well, what do we do next? I don't know. Will Staples sell it? I have no idea. QuickBooks has came out and said they're not going to be doing anything with this. So I don't know where you're going to go to get these forms or how to get that taken care of. And we did quite a bit of research when we were trying to find our own solution of dealing with this. So now the next question is, we say, I really don't think it's possible for accountants or clients to do this. And after you see all this, you should be like, yeah, this is really a nightmare. I'm not sure how we're going to implement this. So the question then is, so what do you tell your clients as to who's going to do it? Okay? Well, here's what all the brokers are telling, and I work with clients that range from 1 to 500. Okay, and I've been talking to all the clients that are ALEs. All the brokers are saying, talk to the accountant. It's a tax thing. Talk to your payroll guy. Talk to this. Talk to this. If your clients' health brokers have said that, it's time for a new broker, guys. Brokers are not educating clients at all with this, and it's their responsibility. How many brokers actually called you up and said, hey, Mr. Accountant, Mr. CPA, I'd like to sit down and talk to you about the ACA, or I'd like to educate you to be able to talk to your clients about it? None. I haven't found another broker that's willing to even come talk to me about it. The only solution that we found that really works for the client, and if it means anything, ADP and Paychex are now doing this as well. We went ahead and started this, and then they released all the notices. You're going to have to combine these things, okay? It's just, there's so many different moving places that the benefits, the HR, the payroll, all of this stuff has to be centralized in one location. There's really no way to talk to 3 or 4 different people and get this job done. The payroll industry's raised their hand to do it. And people may say, well, that makes sense. They have the wage data. The wage data is such a small part of all of this. It's just to find out whether or not they're affordable or not. Timekeeping could be done. The point is, nobody was raising their hands, so the payroll industry did it, okay? So the solutions, all right? Small payroll companies aren't doing this, okay? ADP and Paychex are rolling out the product, but it's going to be really expensive too. With ADP and Paychex, they're coming out and they're making your clients get on the big Workforce Nows, the big paycheck systems, which I know I'm a competitor, but they suck. We pull stuff off all the time. They're very clunky, and they're expensive as anything. So not only are they going to be expensive and clunky, the clients are going to be forced to go up there. Any solution, though, has to have monthly ACA classification tracking. You have to have the affordability tracking. You have to have employee onboarding. Because of all this information, there's no way a paper system is going to be efficient. Employee benefit enrollment system, because once you figure out that they're eligible, then you need to get them enrolled. And then you need to have 1095-C electronic reporting. And what you're saying, well, why electronic? Why can't we just do it paper? Well, if you're familiar with W-2 rules, it's like over 250 employees, you have to do everything electronically. Well, most of the people that are eligible for ALE stuff, they're going to have a lot of employees. We have a gymnastics company that we do payroll for. They've had 400 employees throughout the year, part-time staff coming and going. Well, you may think, well, they don't have, well, yes, every single person that worked for that company needs a 1095-C. So just because your company has your client's company has an average of 50 employees or 60 employees, if they have high turnover, you're going to need electronic reporting. Now, here's the other thing which a lot of people aren't talking about. It's the HIPAA compliance, too. And the other thing is here is you're going to have ERISA stuff. So what we're strongly recommending is that whoever handles the ACA is also the broker as well with it, okay? So that's kind of what we're seeing with this. And if any of you have clients that are using Paychex, here's a funny tidbit for you. Paychex sent out this blanket notice to every single client, whether they were an ALE or not, that said, hey, we're going to bill you $100 a month plus $1 per employee per month for ACA reporting, whether your client was eligible or not. We picked up 6 clients this week because the clients didn't know about it, all come from Paychex that had 5 employees or less. 5 employees or less. They're not eligible for this crap. So just be on the lookout for this. This is a new industry that's kind of booming here, and everybody's trying to feel their way through here to find out how do we deal with this. But these are the solutions that have to be in place. So you're saying, okay, John, that's great. So what do we do? All right. Well, here's my sales pitch for you. All right. We're doing all of this stuff. That's why you're on the webinar today with it. You're talking to people that understand it. We have a complete solution in place. We're already taking care of the brokering. We're taking care of the payroll and ACA requirements. We have employee onboarding, the whole 9 yards with it. So that's what a complete ACA solution needs to have. And I encourage you, after going through and listening to this, you're going to see a lot of different things in here. And I tried to limit the sales pitch for you. But there is such an extensive list of things that you have to do that, there really is no feasible solution to doing this. I want to thank you so much for joining us today. If you have any questions, feel free to shoot me an email, johnp@payrollservicesllc.com, or you can give us a buzz at 1-888-WAY-2PAY. Our local line is also 240-699-0060. I will be reaching out to you guys that have been attending these. Again, if you have questions, give me a buzz. I have no problem spending some time with you to help you out with your individual situation or your questions. Again, we will be sending out the recording for this, so if you have any questions, you can go back and rewind. Again, I want to thank you today for your attendance.